Price pushes higher, but the entry is already behind it. The session forms near lower memory. May 5th Asia session forms near the lower boundary of May 5th US session box. It does not form far away. It overlaps near the lower side. It starts close to decision. That matters. When a session forms near the lower boundary of another session box, the market has to prove support. If price cannot hold there, the move breaks down. If price holds there and starts to move away, the long can begin before the breakout looks obvious. That is the key. Do not chase the candle after it runs. Find the place where sellers fail first. May 5th Asia session first stays inside its own session box. Price rotates there. It does not leave cleanly. Bodies stay small. Reactions come back. The box keeps holding price. Nothing is free yet. Then price starts to lift. It reaches May 5th Asia session upper boundary. It breaks above. That break matters. But the trade should not start there for a late trader. The better question comes earlier. Did price hold the midpoint? Did sellers fail to push through lower memory? Did price start to move away from the middle before the upper boundary broke? That is where execution begins. Now price continues. It breaks above May 5th US session upper boundary. The move now has strength. But strength is not entry. Strength is confirmation. The entry already needed to form lower. Then price pushes again. It reaches January 6th US session lower boundary. That area matters. It is not only a 1-hour level. It sits near December 2025 daily chart basis box lower boundary. It also sits near December 2025 weekly chart basis box lower boundary. It also sits near the 2026 monthly chart basis box lower boundary. So price is not just reaching another intraday target. It is reaching larger memory. A trader must feel that. The long can still work. But late buying there becomes dangerous. The move has already traveled. The next boundary is not ordinary. Now go back to the actual setup. Long entry line. May 5th Asia session midpoint. Stop loss line. May 4th Asia session upper boundary. Take profit line. May 5th Asia session 150% area. The entry sits at May 5th Asia session midpoint. Why there? Because price was still inside the box. The upper breakout had not fully opened yet. The midpoint becomes the first line, where sellers must keep pressure. If price holds below the midpoint, the long is weak. If price reclaims the midpoint and keeps moving away, buyers start building control. So the midpoint is not random. It is the first balance line inside the May 5th Asia session box. Price moves around it. Then it starts to hold above it. Distance begins to grow. Reaction becomes slower. The long begins before the crowd chases the upper break. The stop sits at May 4th Asia session upper boundary. That stop is under the active structure. It gives the long room to survive. If price falls back through that older upper boundary, the May 5th Asia long has lost too much control. The trade is no longer clean. That is where the position must be protected. There is another possible stop. May 5th Asia session minus 150% area. That can also be used. It gives more room. It can protect against deeper noise. But every stop must pass the same test. Can the target still pay? Can the trade still survive? Does the risk-reward still make sense? A deeper stop can be acceptable when the structure needs room. But if the stop becomes too deep and the reward cannot carry it, the answer becomes no trade. Risk must earn the right to exist. Here, May 4th Asia session upper boundary gives a clean structural stop. The take-profit line sits at May 5th Asia session 150% area. That is the first extension target after price leaves the box. If price reaches there and stalls, the trade has paid. If price holds and moves away, then the trail can begin. Price moves up. It breaks above May 5th Asia session upper boundary. It breaks above May 5th US session upper boundary. It reaches the first extension. The long pays. Now pressure changes. The easy part is over. The clean entry is behind you. Now the market moves into larger memory. Trailing target. January 6th US session lower boundary. Risk-reward ratio, 2.09. That trailing target matters because it lines up with higher timeframe memory. December 2025 daily lower memory. December 2025 weekly lower memory. 2026 monthly lower memory. When a 1-hour trade reaches that kind of area, you do not treat it like a simple breakout. You protect the profit. You watch the reaction. You do not assume the next candle will keep running. Price reaches. It tests. It must prove holding. If it cannot create distance, the trail has done its job. Now the stop must follow. A trailing target without a moving stop is just hope. The market has already paid, so the position must protect what it earned. But the stop cannot be too tight. If you pull it too close, normal reaction touches it. Then the trail hurts the trade. If you leave it too far behind, the trail protects nothing. The stop must follow structure, not fear, not greed, not excitement. If price holds above May 5th Asia 150% area and keeps building distance, a trail toward January 6th US lower boundary can continue. If price reaches that area and reacts back quickly, you protect the trade. Now partial profit can help. If price reaches the first target and starts to stall, protect more first. A conservative trader can take 60% first and leave 40% for the trail. If price holds the first target and distance keeps growing, a trader can leave more for continuation. An aggressive trader can take 40% first and leave 60% for the trail. Both approaches need the same rule. The remaining position must have a stop that makes sense. If the second push slows, do not wait for the perfect top. A conservative trader can take 50% first, then 30%, then 20%. If pullbacks stay shallow and reaction does not return fast, an aggressive trader can press harder. An aggressive trader can take 20% first, then 30%, then 50%. But the percentages do not save a weak trade. They only manage a trade that already has structure. If price cannot hold distance, protect more. If price keeps holding distance, let the rest work. Now the full May 5th Asia structure becomes clear. May 5th Asia session forms near May 5th US lower boundary. Price rotates inside the May 5th Asia box. It breaks above May 5th Asia upper boundary. It breaks above May 5th US upper boundary. It reaches January 6th US lower boundary. The long starts at May 5th Asia midpoint. The stop sits at May 4th Asia upper boundary. The first target sits at May 5th Asia 150%. The trail reaches January 6th US lower boundary. Risk-reward ratio, 2.09. The trade works because lower memory holds. It works because price moves away before the upper breakout becomes obvious. It works because the target is not random. It works because larger memory is respected. The market gives the long. Then it reaches a bigger wall. That is where the next decision begins. Price reaches higher memory. But the short is not automatic. The session forms above recent structure. May 6th U.S. session forms near the upper boundary of May 5th U.S. session box. It also forms above May 5th Asia session upper boundary. So price is still high. It is not starting from lower memory. It is starting after the move already traveled. That matters. A high session can continue, but it must hold. If it cannot fix direction, the trade becomes dangerous. May 6th U.S. session then rotates around the lower boundary of May 5th U.S. session box. Price keeps moving around that lower side. It does not leave cleanly. It does not create stable distance. It rides the line. That is the problem. When price rides a boundary, traders feel action. But the market may still be undecided. It moves down. It reacts. It returns. It tries again. Distance stays unstable. Then price falls. It tests. May 6th U.S. session minus 100% area. That looks bearish. But a test alone is not enough. A trader still needs a clean entry line, a stop line, a target line. Without that, the trade becomes emotional. Looking at May 6th U.S. session, easy entry is difficult. Price keeps rotating around. May 6th U.S. session lower boundary. It cannot fix a clean side. The safer trader waits. No trade protects the account. That is the conservative answer. But there is a more aggressive view. May 6th U.S. session forms above the 120 moving average. The basis candle is a bearish candle, with almost no wick. That matters. The candle opens. It pushes down. It leaves little hesitation. It shows selling pressure early. So probability can lean short, not because price is low, because the session opens high and fails to hold higher memory. But probability is still not entry. The hourly flow must support it. May 6th U.S. session does not fully lock direction. It keeps rotating. It keeps testing. It keeps pulling traders into both sides. So a conservative trader should not force entry. Still, an aggressive trader can study the short setup. Short entry line. May 6th U.S. session midpoint. Stop loss line. May 6th U.S. session upper boundary. Take profit line. May 6th U.S. session minus 200% area. Risk-reward ratio 2.95. The short entry sits at May 6th U.S. session midpoint. Why there? Because the session keeps working around its lower half. If price loses the midpoint and cannot reclaim it, sellers can press toward the lower extension. The midpoint becomes the decision line. Above it, the short is weak. Below it, pressure can build. But the entry needs discipline. Price must not simply touch the midpoint. It must fail to stay above it. It must move away. It must keep reaction small. If price crosses down and immediately returns, the short is not ready. The stop sits at May 6th U.S. session upper boundary. At first, that stop can look too shallow. It feels close. It feels easy to touch. But look at the behavior. If price comes back and tests May 6th U.S. upper boundary, the short idea has already changed. The move has retraced too far. The session has reclaimed the upper side. Direction has shifted. So the upper boundary is not just a tight stop. It is the line where the short loses control. If price reaches there, you leave. No debate. No hope. The target sits at May 6th U.S. session minus 200% area. That is the downside extension. If the midpoint fails and price keeps moving lower, that is where the short can aim. Risk-reward ratio, 2.95. The number looks good, but the setup is still aggressive, because May 6th U.S. session did not give a perfectly fixed direction. It rotated. It rode the lower boundary. It tested down. It reacted. So the trader must choose. Aggressive trader can execute only with strict stop discipline. Conservative trader waits for cleaner structure. Now there is another question. The yellow circle A, May 5th Asia session last hourly candle. The question is whether a short entry could form at May 5th Asia session 200% area. That question is valid, but it needs caution. The negative factor is timing. The candle appears right before the U.S. session begins. That is dangerous. Before a new U.S. session basis candle, the market can reset. A level that looks like rejection can become the origin of the next box. A short can be correct and still get trapped by session formation. So timing argues against entry. Now the positive factors. Price has moved far from the 120 moving average. Distance is stretched. The previous candle failed to continue higher. The test above did not hold. That supports short pressure. So the setup is mixed. Not clean, not useless. Mixed. That means the answer depends on the trader. An aggressive trader might take it with smaller size and a strict stop. A conservative trader should wait. If aggressive entries have failed often, choose the conservative answer. That matters. A trader must know which mistakes repeat. If aggressive shorts keep getting trapped, do not call it opportunity. Call it a pattern. Then change behavior. The market does not reward the trader who always acts. It rewards the trader who knows which action fits the structure. Now return to May 6th U.S. session. Price forms high. The bearish basis candle gives pressure. The session rotates around the May 5th U.S. lower boundary. Price tests May 6th U.S. minus 100% area. The aggressive short setup can use May 6th U.S. midpoint as entry. The stop sits at May 6th U.S. upper boundary. The target sits at May 6th U.S. minus 200% area. Risk-reward ratio, 2.95. But the main lesson is not the short. The main lesson is selection. Not every bearish candle deserves a trade. Not every distance from the 120 moving average deserves a short. Not every failed test becomes execution. You need the session to give the line. You need price to fail there. You need distance to build after entry. If price only rotates, you wait. Now connect the day. The earlier session gives the clean long. May 5th Asia forms near May 5th U.S. lower boundary. The midpoint holds. Price moves up. The long pays into larger memory. Then the next session becomes difficult. May 6th U.S. forms high. The bearish candle warns. The lower boundary gets ridden. The minus 100% area gets tested. Short looks better than long. But conservative execution waits. Aggressive execution needs strict rules. Same method. Different answer. One setup gives long. The next setup gives caution. A possible short exists, but it must survive timing, rotation, and stop logic. Price reaches. It reacts. It holds or fails. If it gives the line, you execute. If it only rides the boundary, you protect the account. The next clean trade begins only when the session gives a cleaner decision.